let's get right into it. I'm Jake Arnold. I'm a real estate investor, but I'm not an attorney or anything like that. So everything that I'm saying, I'm not raising money from this or anything like that. So don't sue me. We're going to talk about stocks today. We're going to talk about real estate. We're going to talk about my expectations of what I think might happen in the next 6 to 12 months and how I'm positioning myself to take advantage of it. We had the debate this week and a lot of different things. So I'm going to jump right into it. Let me just share my screen here. I actually have a presentation for us to go into. So next week we have rate cuts, and rate cuts obviously have a major impact on real estate, right? Basically, rate cuts are expected to happen next week, but nobody knows. I mean, like, it's pretty much a sure thing. These are the current 30-year, 15-year mortgage rates. This was taken today. And as you can see here, from Freddie Mac, we have U.S. weekly averages as of September 12th, 2024. The 30-year fixed rate mortgage is about 6.2%. And this is down about 15 points in the last week. So ahead of the rate cut by the Fed, the rates have already been coming down, right? And we've seen that over the whole year. So the 1 year change is almost a full 1% that rates have come down. And that's without any federal government or central banks interference, right? That's from a flight into treasury bonds. There's more demand for bonds. So that's driving the yield lower. And the 15-year rate has fallen even more, right, in the last 1 week and the 1 year. And this actually, we've had an inverted yield curve for the last 2 years, and it's went back and forth a couple times, but it looks like it's finally uninverted. So that's a great thing. But rates have a massive impact on real estate. The markets today, I also wanted to touch on that, because the last week they've been going down, right? And this is, I'm going to mostly talk about real estate because I'm a real estate investor, but the markets do have an impact on real estate as well. In general, the markets have an impact on how much liquidity is in the environment of real estate. So this is like how everything closed. The Dow Jones Industrial Average went up by about 0.58% today. The NASDAQ about 1%. The S&P index about 0.75%. But there's been a massive sell-off the last 2 weeks, right? And that's because the market is shaky. And the Fed is expected to drop rates next week. The Fed's meeting on September 17th. That's when the Fed meets, September 17th. So that'll be, what day is that? What day is the 17th? So that'll be Tuesday. That's when the Fed's meeting. That's when they're making their decision. A lot of people think that they are going to make a 25 basis point cut rather than a 50 basis point cut. But there are hopes out there that they make a 50 basis point cut. I would say that that's probably unlikely. But, there's something else that happened this week. I don't have that slide up yet. I'll get into that later. But the BLS, the Bureau of Labor and Statistics, revised the Bureau of Labor Statistics revised their whole jobs report for the whole year. Right? They revised everything down. There's about 800,000 less jobs than what they reported all year long. So they've been revising all these numbers, and the markets have been reacting because of this. With a lot of other things, right? But crude oil is one of the things I'm going to do in this video today is I'm going to give away a play, like a stock play, because I can give away real estate plays all day, but anyone can buy a stock. You can buy it with $50 or whatever, right? So I do invest in stocks as well. Not as much because I know real estate. And with stocks, in regards to stocks, I think you're buying a piece of the company. And so I'm looking at things when I'm underwriting a company, like how much real estate do they own? What is their assets like, right? Like I'm not even buying it for the stock per se. I'm buying it for the assets on their balance sheet and things like that. So one of the things that I'm going to talk about later is a good trade I think that that I'm making, and it's based off the WTI crude oil index. And that's crude oil prices, that's oil prices, and oil prices have been falling lately. As you can see here, there's a 1 year chart. The end of 2023, in the winter, there's a lot of demand for oil, but there wasn't a ton this year. There was more supply than demand, and prices went down. Right. So then you see April, they come back up in the $85 a barrel range, and the market is, even though we've had a sell off, as you can see here, the last in August, the end of August here, and going into the first week of September, the S&P index is up massive, right? So there's massive gains in the S&P index. Now, real estate uses leverage. So that's why interest rates are such a big deal when it comes to real estate. And that's why the stock market as a broader whole is such a big deal when it comes to real estate, because the amount of liquidity in the environment, in the market, determines your pricing or your purchasing power, right? So if there's more purchasing power in the market, then you should be able to ask for better pricing. So because most people are using 80% leverage on real estate, like when the most people go out and they get 80% leverage or 65% leverage, whatever, something within that range. But for most people, it's 80% leverage, let's say. So 20% is the cash that you have, 80% is debt, and you're paying interest on that debt. Of course, interest rates affect the real estate market, right? 80% of it is leverage. So your interest rate is a massive factor in regards to your monthly payment, right? So interest rates are historically average right now. Everybody thinks they're going to drop them next week, and I would say they probably are as well. As you can see, anytime that we do raise rates crazy, we typically drop them as fast as we possibly can, as quick as it's safe to do. But yeah, I mean, recessions, like this is why I have this chart up here, is because I wanted to look at, do rate hikes and rate cuts cause recessions every single time? So there's a lot of people have been saying like, oh, every time they cut rates, now we're going to have a recession, because once they start cutting rates, that's when the recession starts, and that's when the big sell-off starts. So I wanted to look at recessions versus rate cuts, and if every time when they started cutting rates was there a recession. So let's look at that here. So in the 1970s, 1972, so this period right here, you can see my cursor there. So this period right here, I'm assuming this is like the Yom Kippur War period when we had oil price shocks, and we were raising rates during this time, right? So we went into the recession because we raised rates, and we didn't drop them until we started coming out. And then likewise, that happened in the end, but that was because of an oil price shock, so it was completely different. But that also happened in 78, I believe. So this is probably 78, right? Or no, this is 1980. So this is when Paul Volcker raises rates to 14%. And you do have a minor recession. And then they drop rates immediately and then raise them again. And you have another recession. Then here, like, it doesn't, this one does look like they start dropping rates and then the recession starts, right? This one, likewise, they start dropping rates, recession starts. So the theory is that the Fed has the best windows into the market, and they're seeing things before the general market does. So once they start dropping rates, that's like the market's in bad condition. So there's a sell-off, and there's usually a recession that proceeds from there. But that is not always the case. If you look back only the last 50 years, only 3 of them, which I guess 4 of them, four out of the last 9, that was the case, or 4 or 5, no, 4 out of the last 7, that was the case on this chart. So take with that what you will. But the CPI report also came out recently. Ooh, crap. I'm giving away what we're going to go over. So the CPI report came out, and this is kind of blurry. That's why I was trying to see if I can make it not blurry. But CPI is your consumer price index. So it tracks consumer pricing broadly in the United States. What are people paying for food? What are people paying for energy? What are people paying for items less than food? So like commodities, vehicles, used trucks, apparel, medical care, services, shelter, all that stuff. Medical care. I think I mentioned that. So this is what the CPI tracks. And inflation is correlated with CPI, right? Because prices are going up, that means that inflation is here. So as you can see here, in February, it was we had a 0% rise. March, we had a 1% rise for food. And then May, we had a 1% rise, 2% rise in June, or a 0.2% rise in June, 0.2% July, 0.1% in August. And then, anyway, for August, we have a 0.2% broadly, right? So that means that inflation hasn't, it's like we have a 4.2% unemployment rate, and hopefully we can kick inflation. But like inflation is not kicked. I just want everybody to know that. Like inflation historically has reared its head, and this case might be different, but it might not be different, where inflation can be sticky and it can come back, and we have to take actions like we did in the 80s. That's why we had such an emergency response in this scenario where the Fed raised rates so fast, because they looked at history and they saw what has happened. So they took an emergency action. And now they're going to start dropping rates, but they can't do it too fast because they want to keep inflation down, right? Because when inflation is crazy, like that, inflation is a society buster. I don't know. I think Trump has been saying that, but it's true. If you read about civilizations, when people start to not be able to afford things, when their quality of life goes down, they start rioting in the street. They start getting upset, and they want change. So it usually results in revolution or something like that. Or in our system, because we're a democracy, it results in the people getting voted out of power and new people coming in and enacting the policy that the people want. So, like if you look at Germany, World War One to World War Two, like the reason that Germany went into World War Two is because there are economic conditions coming out of World War One. The reparations payments that the United States and Europe imposed on Germany basically broke the mark, right? Their currency, inflation was so crazy over there that they had cash registers in the store that would ding. And every time it would ding, that means that your dollar lost 25%. So you lost purchasing power, while you're in the store, and it would ding to let you know that the cash register would. So that's how bad inflation was in Germany with the mark after World War One. And because of that, the people were very upset, and people were looking for a leader to get them out of the severe economic conditions that they were in. And there comes Hitler. So this, like, that's, and Hitler, I'm not going to talk about Hitler, but like the economy did better, and then Hitler got crazy, and there's all this really interesting research about World War II, but inflation is very scary. So it's important that the Fed doesn't raise rates too fast, right? And they know this, and I think Jerome Powell knows this. So shelter makes up a big part of the CPI. And for this month's CPI, shelter was, let me see here. What was shelter? Yeah, for this month's CPI, shelter was the reason that it raised, right? The reason that we're up 0.2% for August is because of shelter costs, because of rent, because of housing costs, uh, because of everything that we've been talking about, with utilities rising, with people aren't really, there hasn't been a huge mass of listings on the market or anything like that because people are locked in. So shelter is one of the things that is not coming down, and labor is another thing I forgot to mention there. And that's the reason that CPI went up for August, is because of shelter. Now, I also want to show you the BLS jobs revision. So all year we've been reporting, job gains every single month. And just recently there has been a revision. They're expecting that about 800,000 jobs or something close to that were actually not created, and they have to revise every single month now down, because I think it was like 2.8 million jobs were created for the year, but now we're down to like 2 million or something. And as you can see here on the left, under the BLS job revision headline, the change in total non-farm payroll employment for June was revised down by 61,000 from 179,000 to 118,000. So that's a big revision down, right? When we went from 179,000 to 118,000, that's a massive revision. It makes you wonder, is our economy actually in the shape that we think it is? Because when you have revisions of this scale, it's massive. So you're down 61,000 jobs to 118,000, and the change for July was revised down by 25,000 jobs to 114,000. From 114,000 to 89,000. With these revisions, employment in June and July combined is 86,000 lower than previously reported. Monthly revisions result from additional reports received from businesses and government agencies since the last published estimates and from the recalculation of seasonal factors. So they are revising, the amount of jobs created down. But we just got the new non-farm payroll data as well. So that's why I'm focusing on markets a little bit too, because there's a lot of data coming out. There's a lot going on. And honestly, like, paying attention to this stuff is, you have to kind of know what's going on, but I think when you spend all your energy paying attention to these types of things, it's you're going to get rid of this information in a few months, right? This information isn't going to matter in a few months. As a historical context, you're going to be able to gauge, like, oh, I remember when our economy was like this before. But for the most part, you want to spend your time learning things that are like withstanding long term. So this is more so just to figure out, like, why is the market going so crazy? Why is it so volatile right now? And it's because everyone's on edge. You have BLS revisions, you have unemployment at 4.2%, and you have the CPI going up. So that's a big deal. And they're definitely going to drop rates, it looks like. So you have less jobs created than you initially thought. You have unemployment at 4.2%. And actually, jobs were added. I guess the jobs report was good this month. So unemployment rate back in February 2023 it was under 3.5%. Now we're up to 4.2. And non-farm payroll employment over month-to-month change, seasonally adjusted, August 2022 to August 2024, is this chart right here in the thousands. And we did add some jobs in August, right? So this news release presents statistics from 2 monthly surveys. The household survey measures labor force status, including unemployment, by demographic characteristics. The establishment survey measures non-farm employment, hours, and earnings by industry. For more information about the concept, statistics, method, both the unemployment rate at 4.2% and the number of unemployed people at 7.1 million changed little in August. These measures are higher than a year earlier, when the jobless rate was 3.8% and the number of unemployed people was 6.1 million. So that's good for the Fed. Like the Fed wants that because that's in economics, like that's a major indicator that you're going to bring inflation down is your amount of unemployment. So this is I now interest rates impact real estate, and actually I want to go over this slide first, and then we'll go back to this slide. So this is from the Pennsylvania Association of Realtors. This is the last 12 months, like sales, the amount of sales that have been happening. And they only have a small snapshot here of 1 year. And, you see this is the chart all the way on the right here that I'm looking at, the sales chart. And you see sales hovering under 12,000 um, in August of 2023. And then you see sales, around the same levels for current, right? So sales of real estate we're doing about the same we were 2023. We're down a little bit, but we're about to go into the off season in Pennsylvania. Oh, this is for Pennsylvania, by the way. This is not national. This is for Pennsylvania. Now, the median sale price, on the other hand, has not been going down. Look at the median sale price, guys. The median sale price on a home in Pennsylvania has skyrocketed. Even though the amount of sales you've had, the amount of listings you've had hasn't really changed much year over year, the prices have, right? What is up with the prices? Why are prices going up so much? So that means that there's demand, right? On the existing supply that's there, because this is less than like a new build, right? There's demand. And population historically has been down in Pennsylvania, but we're going to get into that later as well. Now, the number of listings is another thing that the Pennsylvania Association of Realtors does well, and that's actually higher. So it's the number of listings has risen year over year, and the number of sales has declined year over year. So when you have the number of listings rise year over year and the number of sales decline year over year, that's not good. But you have the median price that is skyrocketed. So it's very interesting. It's very interesting to see what's happening in Pennsylvania, our local market. So the bets I'm making, though, I'm not going to give these away, but I'm going to give away a couple bets, and in a couple years you're going to be like, oh wow, I wish I listened to Jake when I was watching this thing, and hopefully it'll give me more credibility online, or just more credibility in general, because I study these things very intensely. But I am not a broker. I'm not making stock recommendations or anything like that. This is just a bet I'm making, and I just want to kind of give you the breakdown of like how I'm coming up with that, right? So I'm betting on real estate first and foremost in Pennsylvania. So we saw some of the other statistics before, but at the end of the day, remember how I mentioned it doesn't matter what the day-to-day news is. That's information that doesn't matter in a month, in 2 months. What matters is your long-term understanding and your decision-making parameters. So I think that real estate is going to continue to go up in value, even if over the next year it goes down. I think that the government is going to be printing money because historically governments have always printed money because it's easier than taking austerity measures. When you take austerity measures, it's hard, and it's hard on the population, and the citizens don't like it. So the government prints money, and that's what always happens. And when the government prints money, it makes assets with intrinsic value go up, right? So real estate is one of those things. I also think that as affordability gets crazy in other areas where, Florida, it's nuts. It's very affordable in Pennsylvania still. There's plenty of land. It's not a terrible place to live. It's just old, and a lot of the infrastructure needs to be upgraded. But what you do see happening is a lot of migration and immigration of the Latin community, and that's putting pressure on the housing market right now. So that's why you see the prices go up, even though you see listings and sales down. But I mean, I'm not saying that that's like the sole cause. Who knows exactly what's happening there? But there's definitely some type of population thing going on in Northeast Pennsylvania, at least, and I'm investing there, and I'm betting that more people move there, that prices continue to go up, that there's more jobs there, high-paying jobs in the near future, and that real estate becomes more expensive because of it. And I also think that like when people move to Florida, and it's the younger generation that's making these moves, and they might get there and then realize that it's not what they thought, and eventually they come back, or they have kids or something and they come back. So um, I think Pennsylvania is an okay place to live, and I think a lot of people will recognize that. I think there's a lot of things going for PA, and so I'm investing in Northeast PA in real estate first and foremost. But on the other side of that, like if you have a decent amount of cash, or if you have a little bit of cash, you don't want to just sitting there, right? You don't want to sitting there idle. And I'm also making this bet on Occidental Petroleum. So I think that oil is like if you look at conflict in the Middle East historically, if you look at like in the 70s, like what were the reasons for the oil price shocks in the 70s? It was because of the Yom Kippur War in 1972 and the oil price shocks in 1978. It was embargoes that OPEC set on the United States, and it caused massive inflation, right? It caused the price of oil to skyrocket, which controls like everything, right? So even though like and these stocks are also, these oil companies are not popular because of the green energy stuff that's going on, because of companies like Tesla, and like everybody's investing in those companies. So petroleum companies are not popular companies. They've been left behind. If you look at PE ratios and things like that, um, like the PE ratio of Tesla is crazy high, whereas this PE ratio is acceptable, right? That's Occidental Petroleum, because people have like forgotten about these companies. It's not popular to invest in them, but the world still runs on oil, and our energy consumption is going up faster than energy efficiency gains. So we're going to continue to consume oil, and Occidental has a really good position in the Permian Basin. Warren Buffett's invested in this company. Lee Lu's invested in this company. A lot of value investors are in this company, and um, they recently made a purchase where they are now the majority landowner in the Permian Basin. And the Permian Basin is a area in Texas where uh, where you have a rock formation, you have a shale rock formation. It's like the best rock formation in this country for drilling gas, because you have different layers, and it's easy to drill different wells at these layers and extract. And the crude oil that comes from these wells is like the viscosity of it is better, and it requires less refining, things like that, right? So it's a really good place to drill for oil. And Occidental Petroleum has the largest amount of land in the Permian Basin. So that's really good, right? Like their land alone, what is that worth? What is that worth? What is their assets worth alone? And then you have Vicky Hullab, who's the CEO, also on the board of Lockheed Martin, but that doesn't really matter. Um, she is an amazing CEO, amazing woman. I've been listening to keynote speeches with her, and reading everything I can about her for the last 2 months. But she basically, like they're trying to pay down debt. They're trying to pump up their cash flow and raise their dividend because they got hit in COVID, right? So they're still recovering from COVID, and they cut their dividend. They're trying to get their cash flow up, and basically, if the price of oil is at $75 a barrel, then they're going to be printing money hand over fist, because they have all this infrastructure, they have everything already set and ready to go. But it's very dependent, their cash flow is very dependent on oil prices. So, in regards to this share price here that I'm showing, $51 a share, if oil gets to $75 a barrel, then Occidental is going to do very well. So you could make a bet, and that's why I highlighted the WT oil index um, earlier, because it's very dependent or correlated with the oil index and our supply demand of oil, right? So if oil goes above $75 a barrel, Occidental Petroleum prints money hand over fist. They report good earnings, things like that. So I'm making, not only am I making a speculation that oil prices will go up, I'm also buying into a good company with really good assets, with really good operations. And they also have like this CO2 capture method. So they have a patented CO2 capture method that allows them to capture CO2 um, coming from the wells, and then they take that and they pressurize the wells, and it allows for more production of the same well, but less at once, right? So it's a more slow production, but it's more consistent. And this is like a revolutionary technology. Like the big thing with oil was like drilling capability. Like we had all these wells that we never thought we'd be able to use because you couldn't get to them. But we had a magic trick that allowed us to figure out new ways of drilling that allowed us to reach these new wells. And so areas like the Permian Basin and things like that became way more valuable. Pennsylvania's Marcellus Shale Foundation became way more valuable because you have this innovation in drilling that allows you to get to different pockets of gas that you couldn't previously get to. And I kind of look at this CO2 capture method and way of that they're doing it, because they've been doing this for years as well. So like they have it down, right? You can't just start doing something and get it down right away. So their wells produce longer. They have this, and they're very environmentally conscious. Um, like they have all these net zero goals, and their ESG score is really good, which I don't really care about that. I don't consider that when I'm investing in a company, the ESG score. But um, if you're getting grants and things like this, they have a lot of cash, or a lot of potential to make a lot of cash, and they have really good assets. So you're buying into a good company below intrinsic value, just with the assets and their potential to make cash flow. And then you're betting that oil prices go up. So if a war breaks out in Iran, oil prices go up. One of the biggest things that are making oil prices go down right now is because you have Iran coming online. They're producing like 2 million barrels of oil a day, which, in the grand scheme of things, that's nothing. But you do have other oil producers coming online. So you've got Iran, you've got Venezuela. They're all producing oil. And this is creating more supply in the oil market, which makes prices go down, obviously, right? And there's things like, the United States Strategic Oil Reserve that make these prices fluctuate and things. It's very complex. So, it's never good to speculate, but when you're buying a company below intrinsic value and you get the speculation, that's a win-win. So this is my bet in the stock market. I don't think you should have a lot of bets. I think uh, you should know like everything you possibly. It takes too much time and energy to learn about a company to know it really, really well inside and out. Um, to have 15 different bets, but I mean, at some point you could, but to have 1,000 different bets or diversify like that, like it's better to know the company inside and out and make really good bets, really big bets on things that you're sure of. So this is mine, and I'm following Warren Buffett and Lee Lu and some of the amazing value investors that I've read everything they have over the last few years, and I think this is a really good company. And I also think that if oil goes up, if there's more regulation on oil, if things like that, if it becomes harder to produce oil, Occidental is going to benefit. Whether that's globally or domestically, Occidental is going to benefit because they're in Texas. Remember that. So really good company. This is basically the only company that I'm studying and investing in besides real estate and my own companies. And I'm not going to be giving away these bets that I'm making in the future. But like I said earlier, the reason why, um, I don't want to you move in silence at a certain point. So I have a quick Q&A session here. We went through everything, went through a decent amount, and I'm very parched. But if you have any questions, please drop a comment. And there's not a ton of viewers, but if not a ton of viewers live, but I saw a bunch of people jump in and out. If anybody has a question, please drop it below, and I'd love to answer it. Anything I talked about a minute ago. All right. Well, thank you so much for watching. Hopefully you got some value out of this, and I will see you next Thursday. I'm doing this every Thursday at 6:30 p.m. to 7:30. The first 30 minutes are going to be going over the market and what I think is kind of happening, what I'm gauging. And sometimes it'll be going over, different real estate transactions we're doing, different purchase and sale methods we're doing, maybe sales calls, comping, a lot of real estate stuff, but also investing, because we want to promote our off-market community, off-market investors community. I think that, like, as AI gets bigger and the internet gets bigger, I think they want to be, you're going to want to be in some type of community that you can trust, that the people that are in it, because there's going to be so many AI bots online that you're not going to know who's real and who's fake. You're not going to know what's a scam and what's not. So I think you're going to want to be in a community that is trustworthy, that's doing good things, that has good vendors, good recommendations, help, right? And I think that's what the future of the internet's going to look like, is you're going to be in these communities that basically you can't believe anything outside of them, but they're going to be the source of information. You're going to have like trusted ones, especially the ones that you're a part of, and you're going to do in-person meetings, because a lot of people crave in-person. We're social people, so being online all the time is not natural. So that's kind of the plan with the off-market investors community. And then in corroboration with that, we have the Osmanic CRM, the AR CRM that we use for our business. So this is a sales CRM, marketing CRM, where you do bulk text messaging. You have a dialer, you have emailing, bulk emailing. You can interface ChatGPT with it, where you're sending these emails with ChatGPT based on prompts and history, and with conversational AI. A lot of different features. We have a few different plans, but it's the most affordable out there and the best software out there. So that's why we're pushing it. We've partnered with the best people in, some of the best engineers in the world to have this software. And since we've put so much time and energy into learning it and developing it, and we've gotten screwed buying it from other people, we built it ourselves and are now selling it ourselves. And I honestly think it's probably the best sales and marketing software out there for real estate people, for mortgage lenders, for contractors, for restaurants, for like a lot of different companies it would cover, because your automated texting, your booking, your appointments, your calendars, all that stuff is there and automated. And we're right on the curve of AI, so we're integrating all of that as soon as it comes out. And we think that in the future, everyone's going to have AI agents that kind of do the mundane tasks. So we're early on that with the tools that are being developed within the Osmanic CRM. And yeah, I think our lowest plan is $47 a month for the basic plan, $97 a month for full access to all features, and then $197 a month for full access to the off-market investor community and full access to CRM. And that CRM is basically like your pass to the off-market investor community, because you should have the tools to do the things that we're talking about if we're talking about them. And either way, it's like, you can have phone numbers on there. It's $2 a month for a phone number, things like that. It's just good to have, and that's, so even if you don't use it, and that's your pass to the off-market investor community, where we have all of our contract templates where we have all of our negotiation strategies, all of our market data, all of our market research, then that's just your past then. So thanks for joining me, and I hope you join me next week. And for all of the off-market investors that are part of the community, I hope you join me tomorrow. We're going to be going over some of the features of the CRM, and then we're going to be doing a deal breakdown, the installment method, because I will be tomorrow. I'll be buying a property using the installment method. We just sold one last week using the installment method that we bought, and I think we got another one that just went under contract that we're selling. So I want to break down the installment method again because I think that's a really good way to do real estate, really creative way, and that's what we're going to be doing a lot of. So join me Friday, 6:30 to 7:30, and that time is going to change because a lot of people don't want to sit on a meet on Friday night. So that might change to Tuesday or something like that. But thanks again, and I'll talk to you soon. See you next Thursday.